Steve, what event risks come to mind that you see coming on the horizon?
Well, right now as we're taping this, the S&P is basically flirting with, if not touching, new all-time highs. You're basically seeing more or less each day somewhat of a carbon copy of the prior day. We wake up, we see the futures up 5 points, the market meanders. Some days it rallies further, some days it sort of finds a level and stops. It's the same story, and a lot of that is because of seasonality. We're seeing it on light volume. It's big vacation weeks all over the world. There's holidays more or less in every major market that we're seeing, if not actual market holidays. Certainly times where people are taking a lot of vacation time. Almost all trading desks are seeing themselves at short staff. One group that remains persistent, though, are corporate treasury departments. Regardless of how few people may be coming to work there, the guy who hits the buyback button seems to still be showing up every day. And what we're seeing then is a real emphasis on market buybacks, keeping the prices afloat. Companies are continuing to buy back shares. That's a big facet of the tax reform, and they're using that capital largely to prop up their own stock prices and their earnings, but that's a whole other topic for another time. But the net effect of that is to reduce supply of available shares and to basically provide a marginal buyer to the marketplace. So at a time where you have a dearth of the normal buyers and sellers, you have this one very large, well-capitalized marginal buyer, and that would be the company treasurer of companies that are buying back shares. So what else is out there? Well, there's actually a lot of news flow hiding around the bend. First and foremost, you've got the Kansas City Fed conference in Jackson Hole. That is not always a guaranteed market mover, but it often is. And I think we're likely to hear some interesting statements from Fed Chairman Powell. And I think it's particularly fascinating this year in light of the recent, what I would call, Fed intervention by President Trump. It's very rare historically to see a president really weigh in much on Fed policy. Most of them have tended to respect the independence of the Fed. And in this case, what we're seeing now, comments that were made Monday of this week, basically that he wished, well, comments that became public Monday of this week. They actually, I think, were made late last week in a private function. But basically coming out and saying he wished he'd had an easier money Fed, that's kind of fascinating. It actually, in many ways, should bother the market a lot more. One, on philosophic grounds, I think the market should not love the idea of an interventionist president, but for the most part, the interventions have tended to work from a market point of view, so the market is probably looking past that. But secondly, I think if you had an easier money Fed right now, with the economy doing what it's doing, with labor force doing what it's doing, you would see a lot more inflation on the horizon. Interestingly, I think the things that are holding back inflation are A, Fed policy, and B, the trade war stuff. So it's actually an interesting mix. Does the inflationary genie get let out of the bottle? Another thing a couple of weeks away, but right now that sort of feels like an eternity, is sometime in September, the Congress is going to have to get together with the president and approve a new funding regime. And that had its own set of hijinks a few months ago during the last round. It's a peculiarly American problem in that they just continually kick the can down the road every few months or so. But you have the interesting combination of a midterm election season and some intransigent groups on both sides of the aisle. And I think it's going to be very interesting to see whether this gets to be enough of a game of chicken to cause worries of a government shutdown or even worse. So that's another problem out there. Another thing that's not well reported, there was a front page story about it in the Wall Street Journal, but there really hasn't been much since then, and that story was a couple months ago, was that corporate treasurers have another reason to invest in the market besides buybacks, and that is to keep funding pension plans. There's a little known feature of the Tax Act, and that was that companies who funded defined contribution pension plans basically could deduct at last year's rate on any contributions that were made prior to mid-September. Well, that's coming around the corner, and I think that's provided a lot of lift, if not to the stock market, certainly to the bond market, because companies in general had been underfunding pension plans, and it seems like it's good public policy to give any incentive to keep companies funding pension plans. But what that means is, as the corporate tax rate shifted from the low 30s to the low 20s, companies have a real incentive to try to maximize any deduction they can at the higher rate, because that's a tax shield that can flow to the bottom line. So it'll be interesting to see what happens when that portion of the spigot gets turned off, because I would have to think that they're overfunding through mid-September, and then you'll probably see a bit of a pullback after that. Plus, you have a Fed meeting in September, so there's a lot of stuff on the horizon. People tend to get nervous in September. I think this time of complacency and good feelings and relative calm is probably a good opportunity for investors to reassess their risks, take a look at whether they seem to be overly concentrated in one segment of their portfolio or another, and whether it's time to think about either reducing some risk exposure and or hedging into what could be a much more volatile September than we've seen in August.